Core PCE, which excludes the cost of food and energy, is expected to cool in September compared to August's print, rising 3.7% year over year and 0.3% on a month over month basis. Now, in his latest remarks, Fed Chair Jerome Powell saying that he intends to proceed carefully, given the bond sell-off and other macro risks, but still reiterated that the 2% inflation target. So what does a data-dependent Fed need to see from PCE and other data points to feel good about the inflation fight? We want to bring in Marvin Lowe. He's State Street Senior Global Macro Strategist. And Marvin, let's break this all down, right? Because lots of anticipation about what we're going to get with this inflation print on Friday, but the movement that we've seen in yields, that has certainly come in focus, whether or not that's going to add enough pressure on the economy for the Fed to stay put. What do you think, and do you see us moving further past potentially that 5% level in yields?
Yeah, I mean, for certain, I think the Fed is not going to go. I think they're going to skip again, ultimately because they told us. So we'll follow like the sheep that the market is when it comes to some of these Fed conversations. The real question is that when you kind of look at their projections and you kind of look at how the economy is performing, we're going to get GDP for the third quarter, which looks very, very strong. You have to question whether or not they should go. We don't think that they're going to go. We think that they actually are probably done for this hiking cycle. But kind of having said that, the data remains hot and it does create some risk that they don't get to that 2% number.
And Marvin, when you think about what the Fed is going to need to signal in order for the markets to believe that there is not going to be a deep or hard recession, but perhaps, as some economists have been predicting, a more shallow recession, what do you need to hear from the Fed on that?
You know what? I don't think, to be honest with you, I don't think that they can provide the comfort in their expectations to get us to a point where we're going to start believing in the soft landing. I think that once they've gone to this data-dependent route, they've really created a lot of risk in terms of just how volatile and just how uncertain they are about how the economy is going to evolve. And as a result, we've kind of seen 10-year yields, the longer part of the curve, trade a bit unhinged relative to what we saw in the middle of the year. And that's really creating the volatility in the market. And that's really making, if you will, some of these more exaggerated moves on the equity markets on any given day.
That's really interesting. So, as you're kind of putting that thought out there, and I mean, we've heard time and time again how data dependent the Fed is going to be, but yeah. I think that's the first time that I've heard that from what you said, and that them signaling that they are going to be more data dependent doesn't exactly put a soft landing in the equation, because then that means that they're going to continuously be looking at some of the more backward facing or rear view mirror data when we're trying to figure out, all right, what's in front of us right now.
Yeah, absolutely. And, I think, their intention certainly was to go all in on the soft landing, go all in the, higher for longer kind of message that they've been providing. In September, however, I think they created a set of economic forecasts that I've been calling the impossible trinity. So, relatively strong growth, unemployment that really shows the economy only slows to a full employment level, this kind of Nehru number that economists like to talk about. And inflation ultimately taking 4 years to get to 2% doesn't really instill a great deal of confidence that they've got a handle on what it takes. So between September and where we are now, we're going to have a strong GDP print. We had a strong employment print. We had a stronger than expected CPI print. That really signals that, maybe the job isn't done. And Chair Powell actually talked about, if we looked at the evidence, we're not restrictive. From that perspective, if we're not restrictive and we still are far from those targets, we should be hiking, but they're not going to. And that ultimately creates some risk in terms of what are they really looking at? That's what the markets really want to know. What is driving their kind of policy thought rather than each data point?
So then, Marvin, I guess diving just right into it, what does then that mean for equities action, that we could see the volatility that could likely be a result of this?
Yeah, for sure. So, I do believe that higher long yields do equate to a certain number of rate hikes. But the higher long yields have been driven by real yields, and they've been driven by term premium. And all of that is, all of those are points that other risk assets need to now compete against. Kind of the inflation discussion in kind of this break-even expectations is sometimes a little bit easier because equities in particular are nominal earning vehicles. They can benefit from inflation if they could pass it on. But that real yield is like, we need a higher number to compete with that real yield. And as that goes up, because there's less comfort, if you will, with the Fed actually having a handle on getting to that 2% number, then you have volatility in the equity markets. And, by all accounts, equities aren't cheap at this point. And we see just how one earnings release, how expectations around that creates the volatility that, we've really started to see across some of these companies and certainly markets.
Marvin, we only got 30 seconds left. I got to hustle to the finish here, but what is your top global strategy right now?
You know what? I think keep powder dry. Cash is about as boring as you can get, but you're earning over 5% of it, 5% on it. I do like bills. I like leaning into a little bit of duration if you like the income, but certainly be nimble.
Marvin Lowe, who is the State Street Senior Global Macro Strategist here. Marvin, we got some big headlines that you just tossed out there. The Fed's impossible trinity.
Thank you.
We might be using that here. Thanks so much, Marvin. Really appreciate the time and insights.